Thank you and welcome into this video. I would like to explain in layman's language what is a stock. This is in relation to stock market. So a stock is just a simple explanation of ownership in a company. So this is a general term which is usually used to explain ownership in a certain company. So as you can see here, we have a company which is a business that need capital. So this company usually issue this stock in the stock market where now investors can start buying shares because shares they are small unit of ownership, and now investor come and buy a piece of that business in terms of shares because you can buy various shares in different companies where you can claim that you usually you have invested in the stock market where you have bought stocks in different company because what companies usually deliver in the stock market on the securities exchange, in the national securities exchange, is the stock, which is the value of that company now which the investor usually subscribe to. In order to understand this, we need to get granular and understand how shares come into place. So share usually come into place when we try and visualize it in so we need to think of a company which is like a pizza where each slice represent a unit of ownership. So a good example to understand how we define shares, you need to visualize an example of a company with 1 million total shares where you only own 10% of those shares. So we can assume this is Apple. So you can say I hold stocks in Apple, but in order to get granular, you want to explain the number of stock which you hold. Now that's where you start explaining the division which you hold, which is 10,000 shares. In order to get the percentage of ownership which you have in that company, you need to take these 10,000 shares, you divide by the total number of shares, which is 1 million, you multiply by 100, and you see that your ownership capacity is 1% of that company. So we need to understand why a company usually issues shares, but the main reason why a company usually issues shares is to raise capital by selling ownership to investor rather than getting to the conventional banking system and getting rent money. So it is just issue the company in the stock market where you can buy to the ownership of that company. So you buy a percentage where you can be sharing the dividend, and also you can be enjoying the price fluctuation in the value fluctuation in the stock market. That is because the company is growing over time, it is expanding the market, and when it is expanding the market share, the value of the company keep on increasing, and you can be able to trade with the shares. So to understand this, we can get it clearer using a flowchart where we have a business that really needs capital. That business issue shares, which is the ownership. Then we have here the investor. The investor buys shares, and now after the investor buys shares, now the company receives the funding. So the stock market connects buyers and sellers. So one share exists, investor can trade them with one another. So to understand this, we have the buyer, we have the market, and we have the seller. But between these, we have a one important element called the stockbroker, who usually link the buyer and the seller in the market. So a buyer wants to buy shares, and because of imperfect information in the stock market, for this buyer to be able to identify a potential seller, they need a market. Because the market usually experience information gap or imperfect, we usually deal with imperfect market, so that this buyer can meet with a potential seller, they need a broker who usually connects these two people in the market, who earn a commission by just connecting this trade and allowing this trade to take place. Because in most scenario, the broker usually enjoy the imperfect information and the information gap which the buyer and seller have. Think of stock market as marketplace for shares. That is the simple language how you can be able to understand the stock market. In the stock market, we usually have two core markets. We usually have the primary market and the secondary market. So under the primary market, this is where the company issue new shares to the investor. So the company raises capital For example, it is the initial public offer. So this is where the company issue the shares directly to the investor. The secondary market now, this is where investor A sell the existing shares to investor B. So that's why it is called the secondary market. So you as an investor, you transfer your shares to another investor rather than buying them directly from the company and you make your margin. So that is the difference between secondary market and the primary market. So the primary market is the initial IPO where the company sells its shares to the general public. Where the secondary market is where now the investor is able to trade with another investor and do the share transferring, making a margin. So this is where most everyday stock trading usually occur. So this is the whole analogy of the stock trading which usually take place daily. It is a secondary market. So an IPO is usually occur once in a while, where a new company has been listed and want to do the initial offering to the general public. So in order to understand how you make money from stock, there are two common sources of potential return from stock market. One of that is is the capital appreciation. This, in simple language, is where you get in the stock market, you buy a share or a stake at $50 maybe, and then you sell it at $70 and you make a potential gain of 20 per share, which is a premium. Also, you earn dividend from that company. So some company usually distribute part of their profit to the shareholders. So dividend payment can provide income. So when you earn dividend, you earn it as an income, and in different economies, dividends are chargeable to taxes or to withholding tax. So when we come to the stock market, it's not every time that you will like capital appreciation or you will earn dividend. Sometimes some company will end up making losses, and maybe you can buy that stake at $50, and maybe you didn't do your due diligence, and the value of the share start declining. Maybe it goes back to $30, and you can make a potential loss of close to $20 per share. And this is not usually the case that the company is not performing. As I explained, the stock market is usually governed by two. It is just a psychological market which is driven by speculation, where I say the dominant factors in the market is fear and greed. So sometimes investors are driven by fear, and when investors are driven by fear, they end up selling their shares in the market. And when the number of sellers is exceeding the number of buyers in the market, what you expect is a significant decline in the stock price, and that can heavily impact the value of the stock which you bought in the market. In some scenario, you may lack some information and maybe buy overvalued shares which are overvalued by greed or over speculation about a certain market. So when you buy overvalued shares, you can end up making significant losses in the market. So we need to understand why stock price usually move. So the price usually changes as a buyer and sellers respond information and expectation in the market. That's what I touched and said. The stock market is usually led by those factors. What I said is fear and greed, because sometimes investors are led by fear due to market expectation. So where we have buying pressure or the bullish market, this is a strong demand. Where we have positive expectation and good earning news, so more buyers are competing for shares, so pushing the price upward. So in this scenario where we have buying pressure or bullish market, this is where the market is experiencing more buyers rather than sellers are willing to give up their shares in a company. This is because there are positive expectation about the growth of that company. So, and also they are expecting good earning from that company. So in case of that scenario, people are not willing to to sell their shares, so they are holding. So that is it usually occur like in the normal conventional market. Imagine you have a commodity which is very scarce and there are a lot of buyers. What do you expect? You expect that the price will rise up. And now this is where now the imperfect information in the market, or the greed usually govern the market, where now people can think irrational and start learning to buy shares of some companies, and maybe they have been overvalued. So now this is where now overvaluation usually come in, because you can buy a share which is overvalued based on the market perception. So where we have now the selling pressure is where now we have the weak demand. The supply is very high. A lot of people are willing to offload their shares. So this is negative expectation. Maybe they're expecting this company might be dissolved or may make losses. So what do investors do? They start offloading their shares. So these, in some cases, this is in some scenario where a lot of people usually make a fortune, because what I said, this market is usually governed by speculation and probability, and investor may be acting through fear, which is not justified, because I said this market operate with a lot of imperfect information, where a lot of trader, in case they lack enough information, they operate at the fear and greed, which usually help people with advantage of information to make a fortune in the stock market. So, but in selling pressure, you need to know that the number of sellers exceed the buyers, and in buying pressure, the buyers are exceeding the sellers. So that is the whole analogy of it. Or in buying pressure, we have a positive expectation in the market, and in selling pressure, we have a negative expectation in the market. So what I would like you not to confuse, there are these three things. We have company, we have shares, and we have stock price. They are related, but they are not the same. So a company, this is the actual business. So this makes product or provides services. A share is a unit of ownership. So it represents a piece of the company which you have bought. That's why I was saying we are taking a scenario of a company which have issued 1 million stock in the stock market, and now you go and buy the piece, which is the share. Maybe you buy 10,000 of those shares, and now you own 1% of that company. So we have the stock price. So the stock price is the market price per share, or the current price, or the market price, or what we can refer as market price per share, or the spot price. Like today, you can have a stock retailing at $50. It can become 60 or 40. That's why we say high and low in the stock market. So to deal with a real world example, we need to calculate ownership and investment value. So we can take that Kin1 Tech Limited has a total shares of 1 million. We can take a scenario where your shares now, you buy shares in Kin1, which you have bought 10,000 shares. So your ownership value is 1%. We can assume that the buying price for these shares is $10 per share. So your investment value, you need to take these 10,000 shares, you multiply by $10, and the investment value will be $100,000. So there was a mistake here. There is $100,000. So we can take now the new price. We can take $15. We multiply by 10,000 shares, and you get that the value of the shares have increased from $100,000 to $150,000. So I have made a mistake. There is a value missing there to $150,000. So this is an appreciation in the market where the share price have increased value with a premium of $5. So this is where we do the real world explanation of what usually happen, but the vice versa can happen in case these shares were overvalued, and maybe you bought these shares at $10, and then these shares were overvalued due to the market's perception, and maybe they declined to $5. So what do you expect? You expect that the value of your investment will now reduce to around $50,000. So that is what usually happen in the real market, and that's why the information and also following the market trend is usually very important. That's why I usually see the stock market, when investing in the stock market, is not really an investment, but you need to see it as a business where you need to invest some time in order you can leap a fortune from the market. So we need to understand what a shareholder own. So a shareholder, or what does a shareholder own? So ownership can move with different, right, depending on the company and the share class. So ownership is a stake in a business. Dividends is the possible distribution. Voting are some shares which have right of voting, and upside is the potential capital appreciation. So this is what ownership can come with a different right depending on the company and the share class. So there are different rights which you get when you own shares in a certain company. You can get ownership, you can enjoy dividend, you can enjoy voting right based on the set threshold of shares which you have in a certain company. Because in case you own a lot of shares in a certain company, you have a significant control of that company, and that's where you get the voting right, because every decision which is made in that company really influence what you have invested in that company, because you are the rightful owner. Let me say, because you have a lot of interest in that company, so you have a very high portfolio, and every decision which is made in that company is significantly affect your investment. So you usually have the upside. These are the capital appreciation which occur in the market. So when you try to understand the difference between a stock versus a share, this is a simple distribution every beginner should technically understand. When we understand a stock, this is a general term for ownership in a company. So this is just a general term. A good example, you can say, I own a stock in Apple. But when we come to a share, this is a specific ownership of a company. A good example, you can say, I own 100 shares in Apple. So when you go to shares, you start getting granular on what you own in a certain company. So this is a complete metamorphosis from a company raising capital to an investor owning shares in a company. So we have a company. So a company issues shares. When a company issues shares, we have an investor who now goes on and buys that share with the help of a market and the stockbroker. Then we have the price which must be set in the market, and now you enjoy the return. So this is a complete picture of what you expect in the stock market. So we usually have the company, we usually have the shares, we have the investor, we have the market, we have the price, and we have now the potential return. So a quick test here. You need to pause a video before, though I have put the answer here. You need to take a company which has total number of shares as 1 million, and you take a scenario where you own the 10,000 shares. So the percentage of ownership which you have in that company, you need to confirm if it is right. You need to take 10,000 divided by 1 million multiplied by 100, and you see that the ownership which you have in that company is 1% of ownership in that company, which is quite significant, owning those shares in a company. So now what you need to know is we have understood what is basically a stock, and we have said a stock is a general ownership in a company. Now what we need now to get deep and understand is what is really a share in a company. Though we have touched it, but now I have made a video where we need to touch what is a share, so that we can have a clear picture of what is a share when you try and explain to someone you hold some shares in a certain company. So thank you for watching. In case you have any query, you can reach me at a personal level using the contact in the description. So thank you for watching, and have a nice day ahead.